In this video, let's discuss regarding accounting rate of return. Okay, first we'll see with the meaning of accounting rate of return. The accounting rate of return method is a financial formula that estimates the profitability of an investment. In simple, we can say that it is a formula that estimates the profitability of the investment. We can say it as returns on investment. Okay, it is a formula to find out the returns on investment. So that is nothing but accounting rate of return. Let's see with the formula of accounting rate of return method. The formula is average annual profit after tax and depreciation divided by average investments into 100. Okay, so into 100 because we are finding percentage here. So we have to multiply with 100. Okay, let's discuss the formula in detail. Here it's given in the numerator that average annual profit after tax and depreciation. I hope you have watched the concept building video of investment decision chapter. If not, you have to watch that video first and later on come to this video, or else you won't understand anything. Okay, in that video I have clearly said that for accounting rate of return method, only for accounting rate of return method we are using CFATD, cash flows after tax and depreciation. Okay, only for accounting rate of return method we are using. And I have also said that cash flows after tax and depreciation is nothing but, can also be said as profit after tax and depreciation. What I have said is profit after tax and depreciation, PATD is equal to CFATD. Okay, CFATD I have said in concept building video. Okay, you have to watch that first. Okay, so here given is also the same, profit after tax and depreciation. In the numerator part also it is the same, profit after tax and depreciation. Here the word average is given. Okay, for that also I will be explaining. Annual profit after tax means yearly. What is the profit after tax and depreciation? Year wise. Okay, now the word average will discuss in detail. I have given an example also for explaining it. Let's take an example. Year 1, 2, 3, 4, 5. Okay, amount is 1000, 2000, 3000, 4000 and 6000. Okay, we have to take the average. I hope you remember in statistics there is a formula for average, summation x by n, right? Similarly, we have to solve here also. Okay, let's solve this. For taking out the average, you have to add 1000 plus 2000 plus 3000 plus 4000 plus 6000 divided by 5. Okay, 16,000. When you add the numerator, you will get 16,000 divided by 5. That will come up to rupees 3,200. Okay, so this is the average annual profit after tax and depreciation. Average annual profit after tax and depreciation is 3,200. Okay, so this is the example of average. Okay, I hope you understood how to take the average. While solving the problem also you will come to know. Okay, so that was regarding the numerator part, average annual profit after tax and depreciation. Now there's important thing to say in the denominator part, average investments. Okay, so for that also we have a formula, easy. Okay, average investments is equal to opening investments plus closing investments divided by 2. While solving the problem also you will come to know what is opening investments, what is closing investments. So we have to take the average of both. Average means summation x by n, right? Here summation x means opening investment plus closing investment divided by 2, right? So that is the denominator part. Let's discuss a very important point. Look at this. CFAT is equal to CFATD. Cash flows after tax is same as cash flows after tax and depreciation. Now I'm going to explain with the help of format. Okay, cash flows before tax and depreciation. From this you are going to deduct depreciation first. Later on you will get cash flows before tax. For cash flows before tax, CFBT, the another name is cash flows before tax after depreciation. Right? I have explained this in concept building video. You can watch in the playlist. Okay? From CFBT you are going to deduct taxes. After deducting tax, you are going to get cash flows after tax and depreciation. Now we want regarding CFATD, right? Now I'll be explaining how CFATD is same as CFAT. Okay? As we know that we are going to deduct depreciation first, right? Later on we are going to deduct tax. After deducting tax, you are going to get cash flows after tax. When only cash flows after tax is given, we have to assume that, or it is known that depreciation is deducted already, right? So we are writing cash flows after tax and depreciation. Okay, hence we can say that cash flows after tax and depreciation is same as cash flows after tax. Okay, I hope you are clear with this concept. If you are not able to understand, then please watch this again. Okay, because this is very, very helpful in solving problems. Let's begin with some problems on accounting rate of return method. Okay, let's see the first question. A machine is available for purchase at a cost of rupees 8 lakh. The expected life is 5 years and the expected scrap value is rupees 1 lakh at the end of the 5-year period. The estimated profit after tax over its lifetime are as follows. Year 1 it is rupees 2 lakh, year 2 it is 4 lakhs, year 3 it is 3 lakhs, year 4 it is 1 lakh 50,000, year 5 it is 50,000. Okay, so this is the question. This question, first you have to put the heading determination of ARR. Okay, later you have to write the formula. ARR is equal to average annual profit after tax and depreciation divided by average investments into 100. Okay, remember this, into 100. Okay, now let's solve the question. See, the cost of the machine given is rupees 8 lakh. The expected scrap value is rupees 1 lakh. Note that. And the expected life is also 5 years. Okay, and the given amount is regarding profit after tax. Profit after tax is same as cash flows after tax. I have explained this in concept building video, right? If you have watched, you will be able to understand this. And this CFAT is same as CFATD. I have explained it now, right? Here, the amount is regarding CFAT, right? Here we have to apply for the formula, but you can't take the amount directly and put. Here given is in the formula there is average. So you have to calculate average annual profit after tax. So first we'll calculate the same. Average annual profit after tax is equal to, now we have to take the average. Okay, let's take the average. First is 2 lakhs, add 4 lakhs plus 3 lakhs, add rupees 1,50,000 plus rupees 50,000. As you know, in statistics, average is summation x by n. Okay, now we have to take the average. Similarly, you have to take the average here. How many years are there? 1, 2, 3, 4, 5. Right? So it will be divided by 5. Don't write 1, 2 here. Just for understanding purpose I have written. Okay. You got there is 5 years. Okay. Now let's solve. While adding all the numerator, you will get 11 lakh rupees. Okay. Now divide by 5. 11 lakh divided by 5, you will get rupees 2,20,000. Okay. This is not the answer. This is only the numerator part of the formula. Now we have to calculate the denominator part. Okay. Average investments. Now calculation is regarding average investments. Average investments is equal to opening investment plus closing investment divided by right? So this is the formula. Here opening investment means the cost of the machine. Here what is the cost of the machine? 8 lakhs. So this is opening investment. Okay, right here is equal to 8 lakhs plus closing investment means the scrap value. Here the scrap value, that is closing investment, is rupees 1 lakh. Okay, write down rupees 1 lakh. Divide by 2. Okay, 9 lakh by 2, it will give you rupees 4,50,000. Okay, 8 lakh plus 1 lakh, 9 lakh. 9 lakh by 2 is 4,50,000. So this is the denominator part of the formula. Now you have to substitute all the values. Okay, this value and this value to the formula, to the main formula. Okay, so here rupees 2,20,000 ARR is equal to rupees 2,20,000 divided by rupees 4,50,000, and the most important thing, into 100. Okay, will give you 48.89 percentage. Okay, so this is the answer. So this is the ARR. Remember to put percentage here. Okay, so this is the answer for the question. Now let's discuss the second question under accounting rate of return. Question number 2. A project costs rupees 5 lakhs and has a scrap value of rupees 1 lakh. Its stream of income before depreciation and tax during the first 5 years is rupees 1 lakh, rupees 1,20,000, rupees 1,40,000, rupees 1,60,000 and rupees 2 lakh respectively. Assume the tax rate at 25% and the depreciation on straight line method. Calculate the accounting rate of return for the project. You have to compute accounting rate of return for the project. Cost of the project is rupees 5 lakhs. The scrap value of the project is rupees 1 lakh. And its stream of income means the cash flows before depreciation and tax. Look at this. It's a very important point. Given the stream of income before depreciation and taxes means the given these amounts are CF BTD. Okay, cash flows before tax and depreciation. CF BTD is given here, not like earlier problem. See here, profit after tax, it was given. Okay, so we had taken it directly, but in this question it's not the same. Here it's given as cash flows before tax and depreciation. Okay, so that you have to consider. That is a very important point here. Okay, assume that the tax rate is 25%. Okay, and depreciation is on straight line method. Okay, now we have to compute the ARR. First you have to put the heading determination of accounting rate of return. Now for your purpose, I had made a small format here. Given is cash flows before tax and depreciation. You have to deduct depreciation first. Then you will get CFBT. From that value you have to deduct tax, and the final value is cash flows after tax and depreciation. Okay, so this value is required for computing ARR. Only for ARR method we require CFATD. Okay, this I am repeating again and again so that it fits into your head. For computing ARR we require CFATD. We'll start with the computation. First you have to draw a table. Put years 1, 2, 3, 4, 5. Then here given is cash CFBTD, right? So put a column CFBTD and write the values. The values given are 1 lakh, 1,20,000, 1,40,000, 1,60,000 and 2 lakhs, right? So this was about CFBTD. Okay. Now depreciation we have to deduct. So we have to calculate the depreciation now. As it is not given directly, we have to calculate. How are we going to calculate? There is a formula. I hope you remember this formula. Depreciation is equal to original cost minus scrap value divided by useful life in years. Okay. If you don't remember this, then keep it in your mind. Note it down. Okay. So here original cost we have to consider. What is the original cost? Rupees 5 lakh is the original cost. Right? Write it down. Is equal to rupees 5 lakhs less the scrap value minus the scrap value. Scrap value is here. Rupees 1 lakh is the scrap value. 5 lakh minus 1 lakh divided by useful life. Useful life it's given here for first 5 years. Okay. So 5 years. Now useful life is 5. So here you have to calculate 5 lakh minus 1 lakh is 4 lakhs. 4 lakhs divided by 5, it is 80,000 rupees. 80,000 is the depreciation. So you have to write under working note number 1. Okay, calculation of depreciation. So 80,000 you have to put in depreciation column. Depreciation remains the same for all the years. 80,000, 80,000, 80,000. Now, from CFBTD you have to deduct the depreciation, right? Now we have to deduct depreciation, and the next column will be CFBT. Look at the format, right? CFBT. So next column will be CFBT. So what you have to put the values here is 1 lakh minus 80,000 will give you 20,000. Okay. 1 lakh 20,000 minus 80,000 will give you 40,000. So for your understanding, I'll put here as 1, here this column as 2. CFBT will be 1 minus 2. Okay, so that you can remember it very well. 1 lakh 40,000 minus 80,000 will give you 60,000. And 1 lakh 60,000 minus 80,000 will give you 80,000. 2 lakh minus 80,000 will give you 1 lakh 20,000. So you have got these values. Okay. Now CFBT less tax. Now here in question it's given assume tax at 25%. Okay. Assume tax at 25%. We have to write here 25%. Now you have to compute tax on which amount? On CFBT. Okay. Tax is on CFBT. So here I'll write here CFBT into 25%. Okay, so that you'll remember it very well after watching the video also. So now we have to put 25% on 20,000. 20,000 into 25% will give you 5,000. Next, 40,000 into 25%, 10,000. Next, 60,000 into 25%, 15,000. Next is 80,000 into 25%, 20,000. Next is 1,20,000 into 25%, that is 30,000. So this was about taxes. Now you require CFATD. For that you have to deduct taxes from CFBT. CFBT minus taxes will give you CFATD. So this 20,000 minus 5,000, that is 15,000. Okay, so I have taught you the format earlier, okay, so that you will understand very well, so that it will be easy for solving the problem. Unless you understand the format, you will not be able to solve it quickly. Okay, 40,000 minus 10,000, 30,000. 60,000 minus 15,000 will give you 45,000. Next, 80,000 minus 20,000 will give you 60,000. Next, 1,20,000 minus 30,000 will give you 90,000. So this was all about CFATD. Okay, now we have to put a total here. Why we require total is, as per the formula, we have average there, right? For taking the average, we require the total. But I'm adding all these values. Here the total will come up to 2,40,000. This is the total CFATD. Now we have to write the formula. I'll just copy paste from here so that there won't be any waste of time. ARR is equal to average annual profit after tax and depreciation divided by average investments into 100. Okay, so here let's compute average annual profit after tax and depreciation. If you want, we'll compute like earlier step also. Okay, so that you don't get confused. Look at this. 15,000 plus 30,000 plus 45,000 plus 60,000. I'll write for you 15,000 plus 30,000 plus 45,000 plus 60,000 plus 90,000 divided by 5 years, right? So here divide by 5. You have calculated the total. It was not required to make this step also. Here 2,40,000 we have already calculated. Just for understanding purpose, I have written this step so that you don't confuse with the previous problem. Okay, 2,40,000 divided by 5. The answer will come up to rupees 48,000. We have got the numerator part of the formula. Now we have to compute average investments. Average investments is equal to investments is equal to opening investments plus closing investments by 2. Right? I'll copy the same formula again. Yes. Here in this question, opening investment is rupees 5 lakhs, right? And 5 lakhs plus closing investment is nothing but the scrap value. The scrap value is 1 lakh. 5 lakhs plus 1 lakh divided by 2. So 6 lakhs by 2 will give you rupees 3 lakhs. Now we have got the denominator part of the formula also, right? Now let's put the value and let's solve the question. Okay, again the formula, let's look. We have got the average annual profit after tax and depreciation is as rupees 48,000 and average investments as rupees 3 lakhs. 48,000 ARR is equal to rupees 48,000 divided by rupees 3 lakhs, okay, into 100. Remember this, 48,000 divided by 3 lakh into 100 will give you ARR is 16%. Okay, so this is the ARR. So take down the solution. So that was all about accounting rate of return method. If you were able to understand this video very clearly, then please give a like to this video. Do subscribe, do comment how was my teaching, and if you have any doubts, you are free to put your doubts in comment section.